You can earn a good salary, pay every bill on time, and still feel like your money is going nowhere. Usually, the problem is not one bad purchase. It is that 4 different money ideas are being mixed together. When income, expenses, assets, and liabilities all look like the same thing, good decisions become much harder. These 4 words explain almost every personal money decision: income, expenses, assets, and liabilities. Learn the difference, and your money starts to look like a map instead of a mystery. First, income. Income is money you earn or receive during a period of time. A salary is income. Money from a side hustle is income. Profit paid to you by a business is income. Interest or dividends from investments can also be income. Income is not what sits in your account forever. It is a flow. It arrives, then gets divided between spending, saving, investing, taxes, and debt payments. Income measures money coming in. Wealth measures what you keep and own after your obligations are counted. Someone earning $10,000 a month can build less wealth than someone earning $5,000 if nearly all of the higher income flows back out. Imagine a paycheck arriving. Taxes take a share. Bills take another share. Every day, spending takes more. The amount left is where financial progress begins. Next, expenses. An expense is the cost of running your life today. Housing is an expense. Groceries are an expense. Utilities are expenses. Transportation creates expenses too. Insurance, childcare, healthcare, and your phone bill are also expenses because they require money to keep your life operating. Some of these you cannot avoid. Others are where your choices actually live. Then there are flexible expenses, subscriptions, dining out, shopping, and entertainment. None of these is automatically bad, but unnoticed spending can quietly become the villain. Planned spending gives you a choice. Untracked spending gives you a surprise. A useful way to understand expenses is to separate fixed expenses from flexible expenses. Fixed expenses are harder to change quickly. Flexible expenses can usually be adjusted this month. Rent and loan payments are usually fixed. Dining, shopping, and entertainment are more flexible. Every month, income arrives. Expenses leave. The money left is what you can use to build safety, own assets, or reduce debt. The goal is not to eliminate every expense. The goal is to make sure your spending supports the life you actually want. An asset is something you own that has economic value. Some assets can grow, some can produce income, and some simply store value. Emergency savings is an asset. An index fund is an asset. Home equity can be an asset. Ownership in a business can be an asset. Assets are not just cash sitting in an account. Some of them work quietly in the background. Cash in an account is an asset. A retirement account is an asset. A rental property may be an asset. Valuable equipment used to earn income may also be an asset. One important detail: not every asset makes you rich. A car may count as an asset because you own something valuable, but it usually loses value and creates ongoing expenses. A useful asset may simply hold value. A stronger wealth-building asset may grow over time or produce cash for you. Money saved can buy an asset. A strong asset may grow in value. That growing value can create more choices later. Buying something expensive does not automatically mean you bought a good asset. A liability is money you owe or a financial obligation you must repay in the future. Credit card debt is a liability. A car loan counts as one too. Student loans qualify as well. So does a mortgage. Some liabilities are planned ahead of time. Others show up uninvited. Personal loans, medical debt, unpaid taxes, and buy now pay later balances can also become liabilities. New debt creates a monthly payment, and that payment claims part of your future income before you can use it for anything else. This is why too many liabilities feel heavy. Before next month even begins, part of your income already belongs to lenders. This is where many people get confused. A debt payment is cash leaving your account, but the entire payment is not always an expense. The interest portion is an expense. The principal portion lowers the liability you owe. Now let us put all 4 ideas into one household example. Imagine a household with $5,000 of income. Living costs use $2,900. $1,000 builds assets. $600 goes to debt payments. $500 remains as a buffer. The salary is income. Groceries are an expense. The index fund is an asset. The car loan is a liability. Money coming in is income. Money used to run life now is an expense. Something valuable you own is an asset. Money you owe is a liability. $1 can play a different role depending on where it goes. You earn $100. You spend 60 on current life. You use 25 to buy an asset. You use 15 to reduce debt. After every major money decision, ask one question. Did this increase my income, create an expense, add an asset, or increase a liability? Here are 3 common mistakes that make these ideas harder than they need to be. First, salary is mistaken for wealth. Second, every expensive purchase gets called an asset. Third, loan payments are ignored because the monthly amount feels affordable. A small monthly payment can hide a large liability. Always check the total amount owed, the interest rate, and how long the payment lasts. Financial progress usually comes from 4 moves: raise income, control expenses, build assets, and lower liabilities. Quick question: which one is hardest for you to separate? Income, expenses, assets, or liabilities? Comment just that one word below. Your answer may become a future money map example. Do not just remember the definitions. Use them. This week, make one simple page. List your monthly income. Mark your true expenses. Add the assets you own. Write every liability you owe. Then find the monthly gap you can improve. You do not need complicated finance language to understand your money. Separate these 4 words, and your next decision becomes much clearer. If this made sense, subscribe. Next time we separate needs, wants, and savings, so your budget stops feeling like punishment.